punishing geography of Sydney's COVID crisis has been much in the news over the past 2 months. The ignition of the outbreak in Sydney's affluent eastern suburbs, yet the rapid concentration of cases in the less affluent west and southwest. It has been the essential workers who can't stay at home, who live in these areas, as well as large multicultural communities who have been hit hardest. Perhaps not surprisingly, there has been a similar economic divide.
The experience in Western Sydney is much worse. Data shows that the small businesses, particularly small independent businesses in Western Sydney, have been hit much harder than Eastern Sydney. Those businesses have their sales down nearly 40%, whereas businesses in Eastern Sydney have been hit much less. In fact, their sales are steady.
Economist Andrew Charlton says there are 3 really big differences in the economies of Eastern and Western Sydney.
The first is that in Western Sydney, the lockdown is much stricter. The second is that Eastern Sydney is benefiting from many people working from home and diverting trade that would normally be in the CBD to the local suburbs. And third, the income falls have been much larger in Western Sydney.
The differences aren't just within Sydney. Zooming out a little further, the state of New South Wales saw roughly 100,000 people stood down between June and July. But those losses were significantly offset by a bounce back in Victoria.
That's why today's numbers are very much a tale of 2 states.
But the economic experience in 2021 is also very different from that of 2020. No matter how bad things seem this time, it's not as bad as last year.
In the last lockdown, we saw spending fall by nearly 20% across Sydney and Melbourne. In this lockdown, it's been less than half of that. And that's because Australians are learning to live with the lockdown.
Something else that has changed the way we view the impact of lockdowns is how the economy recovered last year.
We went very quickly from the worst economic growth in recorded history to the strongest Christmas we've ever seen.
Last year's nationwide lockdown and economic crisis has become a much more patchy economic fallout this year. But the relative simplicity and confidence of JobKeeper has also been replaced by a much more confusing tapestry of support from the federal and state governments.
A direct payment to businesses up to a turnover of $50 million a year.
Payroll tax exemptions and other opportunities for businesses to get support from us. And they're specific to our state.
The government's had 4 cracks now at replacing JobKeeper, and each time they've come up with something inferior. Cutting JobKeeper in March is looking like a really dumb decision.
The banks are reporting much lower levels of distress than they were last year. Figures provided to 7:30 by the Australian Bankers Association show a pickup in the number of home loans on pause as the New South Wales crisis grows. Businesses are pausing their loans too, but at a much more gradual rate, with only around 1,400 on ice by last week. That's not too bad, given last year there was much greater volatility in the company loan market, with tens of thousands of such changes every week. There has, however, been an increase in the number of cases of hardship recognised by the banks to just under 40,000 over the course of the past month. Something else is also very different this year. The sheer weight of money that has been pumped into the economy by government has led to a huge increase in household and business savings. More figures from the ABA show that together, business and household deposits have grown by a staggering $279 billion since February last year. That's given economists cause to believe that if the health crisis starts to ease, the economy will once again recover reasonably quickly and a technical recession may be avoided. But will it be quite the snapback it was last time?
The fundamentals that drove that snapback last year are still present. We still have incredibly low interest rates. We still have a lot of government money surging through the economy, and consumers are still building up that big stockpile of savings heading into the end of the year.
But there are conflicting views.
So, it's been quite extraordinary that over the last little while, we've seen our confidence holding up, but we're starting to see that soften a little bit. We're starting to see that with extended lockdowns, the frequency of them, the impact that they're having on the economy, that people are getting a little bit fed up. We're seeing small business closures starting to rise. These things are not good for the economy going forward. And we get not just vaccine hesitancy, but investment hesitancy. And so we've got to get this right.
We should take confidence from a couple of things. First of all, we've seen other countries, particularly Britain, come through the living with COVID experience and high vaccination rates. They recorded a high GDP growth figure in the most recent quarter of 4.8%. What matters is that we support the businesses and consumers so they're able to bounce back quickly and don't see the scarring effects that we often see after recessions, which cause the aftermath of economic shocks.
Hi, I'm Lee Sales. Thanks for watching this story. If you'd like to watch more of 730's stories, they are on the left of your screen. And tap on the button below to subscribe and get the latest from ABC News.